Welcome back to The Explainer. Today we're popping the hood on the half-trillion dirham financial engine that is literally powering Dubai's wildest economic ambitions. We're talking about Dubai Holding. If you've ever found yourself wondering how a megacity actually funds its future, well, you are in exactly the right place. So how do you engineer a half-trillion dirham financial empire? Just let the sheer scale of that sink in for a second. Managing a portfolio of this magnitude isn't just about throwing up skyscrapers or opening luxury hotels. No, it is a massive exercise in ultra-complex financial engineering. The real challenge here is figuring out how to restructure, refinance, and optimize these huge legacy assets into one sleek, high-performing corporate machine. Let's break down exactly how they pull it off. Here's our roadmap for today. 1. The Dubai mega merger. 2. Unlocking cash through refinancing. 3. A look inside the residential REIT. 4. Strategic accounting and valuations. 5. Forecasting future growth. And finally, 6. Treasury tactics and risk mitigation. Let's dive in.
Section 1. The Dubai Mega Merger. Architecting Scale and Efficiency.
Okay, so the very first move that really set the stage for everything else, achieving massive, and I mean massive, scale. The government essentially took legacy real estate giants, specifically Nakheel, the developers behind the Palm Jumeirah, and Meydan, and folded them directly under the Dubai Holding umbrella. Boom! Suddenly you've got this unified entity managing an estimated 500 billion dirhams in diversified assets. Now why do this? Well, it aligns perfectly with the Dubai Economic Agenda, or D33, which has this incredibly ambitious goal of doubling the Emirates' economy by 2033. By smashing these entities together, they wiped out corporate redundancies, streamlined the whole operation, and instantly forged a financial juggernaut that can go toe-to-toe with anyone on the global stage.
Moving on to Section 2. Unlocking cash through refinancing. Consolidating the capital structure. 30 billion dirhams. To put that in perspective, we're talking roughly 8.2 billion US dollars. To stabilize the capital structure of these newly merged entities, Dubai Holding pulled off this frankly awe-inspiring syndicated loan. This single massive transaction refinanced the fragmented and, let's be honest, historically restrictive debts of Nakheel and Meydan. And the brilliant part? They tapped into localized banking relationships to secure really favorable terms, totally sidestepping the crazy pricing volatility you typically see in the international bond markets.
Now, that 30 billion dirham loan accomplished 3 absolute game changers for their balance sheet. First off, it consolidated restrictive covenants. They basically swapped out a bunch of messy, fragmented, project-specific cash sweeps for one unified senior debt instrument, much cleaner. Second, it extended their maturity profiles, trading in short-term loans for long-term facilities that actually match up with the multi-year timelines of their mega projects. And third, this is the big one, it liberated operating cash flows. Capital that used to be tied up servicing aggressive debt, totally freed up. Now they can redeploy all that cash right back into high-value future projects.
Which brings us to Section 3, inside the residential REITs, the high-margin cash engine.
So leading up to 2024, the Dubai Residential REIT saw its revenue climb pretty steadily, going from 1.45 billion to nearly 1.8 billion dirhams. But honestly, the metric you really want to pay attention to here is the occupancy rate. Hitting a 97% average across more than 35,000 available residential units, that is wild. It's a massive testament to their operational efficiency and their deep focus on customer retention, which sat at a really impressive 87% in 2024. People are moving in, and they're staying.
And to buffer this REIT against sudden market shocks, they aren't just relying on shiny, ultra-luxury housing. Actually, out of the projected 1.95 billion dirhams in 2025 revenue, the vast majority is driven by the community and affordable segments. That is a huge deal. Having this kind of diversified asset mix acts like a shock absorber, guaranteeing them highly predictable rental yields no matter what the broader macroeconomy is doing.
All of this feeds directly into this phenomenal result, a record FY 2025 net profit of 1.28 billion dirhams, backed by a massive 93.5% free cash flow conversion rate. Just think about that. That cash conversion is actually up nearly 4 percentage points from the year before. This sheer volume of liquidity is exactly why this REIT is such a powerhouse, dividend-paying cash engine for the parent company. It lets them confidently target a dividend payout ratio of at least 80%.
Section 4. Strategic accounting and valuations. Engineering the balance sheet.
Okay, let's look under the hood at the accounting rules, the actual financial gears that protect Dubai Holding's pristine A-tier credit ratings. We need to talk about International Accounting Standard 28,
or equity method accounting. In plain English, this rule means that when you own a significant minority stake in a company, you get to claim your proportionate share of their profits right on your income statement. But, and this is the absolutely crucial part, you do not have to drag their massive liabilities or debts onto your own balance sheet line by line.
So, why does this matter in the real world? Well, Dubai Holding happens to own a nearly 30% stake in Emaar Properties, and Emaar just had an absolute monster of a year, pulling in a historic net profit of 25.7 billion dirhams. Because of IAS 28, Dubai Holding captures its share of that massive upside, raking in rich dividends to fuel its own treasury, while totally sidestepping the need to consolidate Emaar's hefty development stage liabilities. It is literally a masterclass in boosting profitability without putting a dent in your credit rating.
Moving on to Section 5, Forecasting Future Financial Growth, Modeling Risk and Resilience. Switching gears from historical data to predictive modeling, corporate analysts use these contrasting scenarios to really stress test the entire portfolio. On one hand, you have the baseline scenario. This assumes a healthy 4.5% GDP growth, nice interest rate cuts down to 3%, and steady rental growth. But look at the downside stress scenario. This models what happens if things hit the fan: regional geopolitical disruptions, GDP growth crashing to just 1%, and a 10% real estate valuation contraction due to oversupply. Running these two extremes is how they ensure this financial architecture won't crumble if the market suddenly turns sour. And the true resilience of this portfolio really shines through in that harsh downside scenario. Even under maximum stress, the financial models show Dubai Holding maintaining an incredibly strong 91% cash conversion rate. How? Because their rental collections are so deeply anchored in everyday, affordable housing, their debt service coverage ratio stays highly insulated. Basically, the cash keeps flowing in even when the broader economic climate gets really tough out there. Section 6, Treasury Tactics and Risk Mitigation, Actionable ACCA-aligned strategies. Historically, roughly 33% of their direct public debt was sitting on variable rates, so mitigating that interest rate risk is absolutely vital. Their first masterstroke to handle this? Interest rate swaps. By aggressively converting up to 75% of their variable debt into fixed rates, they lock in declining borrowing costs. The second major tactic is parent-level cash pooling. It sounds complex, but basically, they centralize all the surplus cash from divisions like the residential REIT and seamlessly redistribute it to fund heavy capital developments in other areas. This essentially eliminates the need to go out and secure expensive third-party loans.
Check out this quote directly from their corporate reporting. In the future, we will continue enhancing the operating performance through initiatives that are designed to grow revenues and improve operational efficiency. It perfectly sums up their underlying philosophy, doesn't it? It's this relentless, mathematically driven pursuit of asset optimization. Whether we're talking about a mega merger, a 30 billion dirham refinancing, or leveraging strategic accounting tricks, literally every single move is designed to squeeze maximum performance and efficiency out of every asset class.
Which brings us to our final thought. We've just walked through the sheer scale of their asset consolidation, the incredible margins pumped out by the REIT, and the highly sophisticated treasury models they use to insulate their debt. As Dubai pushes aggressively to literally double its economy by 2033, you really have to ask yourself, given this highly structured, defensively modeled financial architecture, is Dubai Holding merely prepared for growth, or are they fundamentally engineered to weather whatever macroeconomic storm comes next? Thanks for tuning into this explainer, and as always, keep questioning the numbers.